All right, what's up, everyone? And hello, everyone, for tuning in. What's going down? My name is Ben Maitland-Lewis. I'm Director of Startup Banking here at SVB. Was a client here for like 16-ish years and then have since been on the banking side for about three since. It's been awesome. I personally work with founders from the inception through the Series A inflection point. So it's highly volatile. It's a lot of hand-to-hand combat. It's a lot of strategic introductions and go-to-markets and co-founder dynamics and, the whole thing. Sometimes it's even psychological in that capacity. And we're here for all of them. And it's awesome. Part of what we do a lot of the times, because we are here from the inception of a company through IPO and then back again, usually we're here for 3, 4, 5 adventures, is helping obviously with capital connections and fundraising, right? Typically it's around go-to-market, commercialization, raising capital. And that's something that we deal with all the time. And it's something that is constantly changing and something that in today's industry we see is changing every single day. And we are at an accelerated rate in that. Deal sizes have been very different. Rounds have been different. Oxygen's been sucked up in certain places, but people are still building. People are still getting funded. People are still trying to make the world a better place for all of us to live in, right? So with that being said, that's why I'm really excited to bring a good friend. Actually, over the last year, we've become friends. He's the man, but we get closer and closer the more we collaborate. Ron Levin, who was first an entrepreneur. Well, actually, if you really dig into it, he was a consultant and worked in a whole bunch of different places, but then started a company that ultimately grew into a massive unicorn, raised over $700 million in venture capital, and is still around today. And then after that, went into venture. Okay, so kind of like me, if you want to say I joined the dark side of banking, he joined the dark side of venture. But Ron has seen so many different deals going on. Alumni Ventures specifically is a top decile VC fund. They're named in the top lists all over the place. They've made over 1,600 investments. He's seen countless deals. But what makes him really unique and a double-edged sword specific for this conversation, which I'm so excited to dive into, is that he was a founder first. Some would say maybe an educated founder first because he was in consulting first. So he's probably really good at making decks and doing, market landscapes. But man, now he's on the other side of the table. So we have a lot to learn from both where he's at now, but also where he came from. And we'll get into a bunch of stuff. He also has a really awesome Substack that I encourage all of you guys to check out. At Ron's encouragement, I checked it out and I went down a rabbit hole and it was really, really awesome. And it's not traditional VC jargon, with respect to all VCs, of course. But it's very real and it's authentic and it feels like it comes directly from a founder's mindset, but speaking from a very successful VC. So it's really cool. So I encourage you to take a look at that. And he also has a book, which, is awesome, called Higher Purpose Venture Capital, because we'll get into that shortly as well. Not necessarily the book, but more about the macro perspective of you can use capitalism to do good. And you can be purpose-driven and you can make the world a better place, but leveraging capitalism to do the two and make them both happen. You don't have to be an asshole. So, with all that being said, are you guys ready to rock and roll? Because I'm about to bring Ron to the stage. Is that good? Guys online, you guys ready to go? All right. Let's expand some network. Everybody give it up for Ron Levin. How fun is this? Good to see you, my friend. Let me just shimmy on up here.
You are just a bundle of energy. I don't know how I'm going to keep up with this.
Oh, get ready, baby. Strap in. Let's first start, if you don't mind. I still want to keep it in the founder vibe for a little while, okay? I know, is this
I don't need a mic or anything, do I?
No, we're just projecting today.
Great.
We're going through some technical things, and like all founders, we go on the fly and we improvise, right?
Yeah.
So no mics today. You guys can hear us, right? We're projecting.
Absolutely.
All right, Zoom, you can hear us? Give me an emoji. All right. So here's the deal. I don't want to spend too much time on this, maybe a couple minutes, but I really do want to kind of set the stage here from you, a historical perspective, how you view the world because you came from the founder's seat. I really want to drill into that. I know that you've had career accolades both before and stuff like that, but specifically when it came to travel for starting our company, right? Did you go and raise the first checks for that company and really get that stuff going?
I was there at ground zero. Absolutely.
Yeah. Okay. So that company is now still successful, which is amazing for you to be able to walk away and see a baby continue to mature. And they've raised over 700 and something mil, right? So they're doing quite well. Seeing from your lens where you are now, right? As the VC who's writing checks and everything else, but trying to put yourself back in your earlier founder shoes, pitching to VCs. What would you have what keeps you up at night of what you would have done differently? Or, what would you tell your earlier self? Like, dude, don't do this or don't worry about that.
Yeah. Oh man. I mean, that's a great question. And usually when I get that question of, what if you could go back and do something again, I often say, I try not to think that way because life's a journey. And, if you don't have those bumps along the way, you miss out on a lot of the learning that comes with these experiences. I mean, I could probably run through a whole list of things I could have done better, differently, would have changed. But, that's life. And if you go through life thinking about all your regrets, you're going to miss all the good things that are ahead.
Totally.
But, all that being said, like I thought like I had read every book on fundraising, every 0 to 1 and venture deals and everything from the VC lens, from the founder lens. So I'd been a management consultant, and I'd been an entrepreneur as a kid. I'd studied entrepreneurship in college and in business school, and so I thought I was all over this. And I had really no clue what I was doing. I was winging it like anyone else, because until you actually go start a real company, employ real people, raise real money, like there's a first time for everyone, and you don't know what you don't know, despite all the best advice. So I was winging it as best I could, and as best as my co-founders and I kind of came together and made the best decisions in the moment. But I think we raised money. Our first round was at a $2.5 million cap, which is like super cheap these days. I just got back from Y Combinator, and these companies that have been around for 6 months that have built product with 2 people are raising at a $30 million cap.
That's right.
What have you done to make yourself worth $29 million on paper? I don't get it. Like I thought 2.5 million, I was already like, but I didn't have to dilute myself. Probably could have done, I don't know, little things like that. But, overall, looking back, I guess the only real regret is that I didn't stay in the company a little longer, just how the trajectory was or has been. But that was kind of based on family reasons, having to relocate and some other factors. But
life.
Overall, life, exactly.
Life. Yeah. I mean, careers are nonlinear. Life is nonlinear. Yeah. It is how it is. But I mean, so what do you think was the impetus at that time, going back really quick to that $2.5 million round, that made an investor have conviction to write you that first check?
Yeah, I mean, one word, team. We thought we had a good idea. My co-founders and I had worked at Booking.com, and I was living in Amsterdam, where Booking is headquartered, part of the Priceline Group. I don't know how much you all know about Booking, but it's arguably the most successful travel business maybe ever, based on if you just look at its financial performance. It was the number one company on the NASDAQ over a 10-year run of all the companies on the NASDAQ. So very successful business, learned a lot there. And my co-founders and I saw an opportunity around business travel that Booking wasn't addressing themselves, for reasons that are actually quite easy to understand. They had a lot of low-hanging fruit just doing accommodations, so why get into the complication of business travel? But it left a gap. We saw customers yearning for a product that we could build. We went to market with something that was a little niche around helping employers save money. Turned out companies didn't really want that, but they told us what they did want. So we built a product by listening to our customers. We got a lot of feedback early on that you're not building the right thing. But our investors saw that too. You asked what did investors see? And when we first pivoted, we raised our first $1 million at basically a $1 million seed round from 1 VC and 9 angels, plus all the co-founders put in some money. And, but 9 months in, after we built our MVP, we completely pivoted to a much broader vision. But what our investors said to us was like, you know what? We weren't really sure you had the idea right, but we believed in you. And that's the biggest vote of confidence. And that's a lens that I always keep as an investor. If I'm investing very, very early, I'm not really that worried if the first product is not the right one, as long as you're willing to learn and adapt and just be agile, because things change quickly. And so it's just critical that you're just paying attention to the market and what the market's telling you.
Mm-hmm. Great to hear. I mean, we often tell our founders too that at this point, especially if you're raising pre-seed, friends and family, even a seed round, that they're still making the investment in you, the founder, above the idea typically. Just like you said, right? Yeah. I mean, a really good idea can come and go, a great team can't. And so I think highlighting the team, and really those strengths and what the superpowers are with you guys collectively. Like our colleague Reese likes to say 1 + 1 = 3. And it's really that vibe of like telling and selling the team, not just the product, definitely not just the features, and not just the vision, but also why can this team take it from 0 to 1 billion? Why is it this team that can mess with it? I remember when we got into YC, I asked those guys back in the day why they ended up actually saying yes to us, and what they said was that it was because we were coachable, and that really sat with me because I was like, I am, and I think a lot of founders are naturally a little thick-headed, rightfully so, you know. But I think having the balance of
No, exactly. And I talk about that often, that it's the right balance of exuding confidence without bleeding into arrogance.
That's right.
And it can be a fine line for some people. Some people are very high EQ. Maybe you kind of seem not really sure how technical they are, or you can look at it from the other lens, very technical, very sophisticated, not sure about their presentation skills. If they can't sell me as a VC, are they going to be able to sell customers? So I try to gauge that very quickly. And first maybe controversial thing I'll say, probably the number one Substack that I've written recently was one that I titled "The Number One Lie That VCs Tell Founders," and it was on this point. So why does a pre-seed or seed stage VC pass on a deal?
And it's because they don't believe that founder can take that company from 0 to $1 billion. They might say something like, "Oh, it's not the right fit for our thesis," or "Oh, we're subscribed," or "Oh," but in reality, it's more than likely that they don't yet have full conviction in the founder.
And it's very difficult for a VC to say that for natural reasons. You don't want to tell to your face, "I don't believe in you," but maybe things will change. Maybe later on I will believe in you. But they walk a fine line, and you're not often going to hear that feedback that we just don't believe in you. But more often than not, that's the real reason.
Yeah. So I'm gonna flip scripts to Scotia here, because I was actually gonna go from here into market stuff, but we're already kind of talking about some of this meat. So let's just stay in lane here. Okay. One of the things that I work with on founders a lot is how to approach and engage with investors, right? And specifically when they don't need money is typically the best time to start building those relationships. And this is why I'm bringing this up, because you actually have a counter in one of your Substacks. One of my strategies is typically, let's introduce you to some of these investors that are in your thesis, potentially even ones that are future rounds, because you're always fundraising and you're always building network, and have a conversation with them. Maybe ask them, for some advice. Maybe ask them if they have some other people they want to talk to or who they could reach out to, and then add them to an investor list and just keep the warm relationship going. It's relationship building 101. And then eventually at some point you flip the script and you say like, all right, we're ready to actually open up the round. It's going to close on XYZ date. Would you like to actually have a real conversation about that?
Yeah.
And then the idea is that you have a long history already with this founder. You've already been able to measure the perseverance, the gumption, the grit, et cetera. And you can go back and play telephone with your partners better. This is the hypothesis that I've been going off of. But then I dug into your Substack, and one of the areas there was like, it's a red flag to you if the first time you meet a founder, they ask for advice. And I want you to dig into that.
Yeah. So it's a little bit nuanced, and I agree. You're always networking, always asking for introductions. When I did my company, I pitched VCs. Sometimes they said no, but hey, I'm going to introduce you to an angel, and that angel actually ended up investing. So yes, it doesn't hurt to ask. But when I've experienced, for example, going to a conference, speaking in a forum like this, founder will come up to me afterwards, pitch me like 60-second elevator pitch. Like, what do you think? Like, what do I think? Like, I mean, I'm not the expert. You should be the expert. Like, if you're asking me and you've just met me what I think, you probably haven't done your homework. Like, you ought to have 100% confidence that your idea is the right one and be able to convince me why, not ask me what I think about the idea. Like you do your homework, I do mine. So my level of diligence comes later. It's you validated the idea. You're already, as a founder, you're putting your life on the line. You're risking money, your lifestyle, everything to do something. If you're not sure, then it's probably an early. If I'm just talking to you as a friend, fine, I'll give you advice. But if this is purely a professional relationship, I need to get comfortable with you before I start spending my time giving you advice. So to me, it's like I'm probably less inclined to invest in someone that on a first meeting is already asking me what I think of their idea, or, who can you introduce me to? Like, I've got a lot of stuff going on. Like, I don't mean to sound arrogant.
No,
I get like hundreds of inbounds like on a daily basis. Like, I simply don't have the time to talk to every founder and introduce them to every VC I know. I'd rather see you do the work than have something that you can show me and say, aha, I get it. And I'm very active. I do a deal a week, one new investment every week, but I still have to filter through countless. So I do write checks and I do say yes. But the bar is still, you come to me when you're 100% confident that you're working on the right idea.
Okay. That's really good intel. Thank you. And I hope that's valuable for all of you guys as well. So what does turn a first meeting for you into a successful meeting?
Yeah. I mean, I want to be sort of convinced of a few things. First of all, any deal I'm underwriting based on something. There's something that I'd said, this stands out for me because of this. But for every deal, it can be something different. Sometimes it's getting pitched an idea that I've never heard before. Like, oh, I've never heard this kind of, this kind of technology that seems to be solving a real problem. I get it. It's a big market. It's just something clicks like, you've tapped into something I've never thought of that sounds really interesting. I want to learn more about that. Sometimes it's just a founder. It's like, hey, this founder has built something before, or they've done something really impressive. Even if they haven't been a founder, they've risen to a pretty senior level in a very respectable organization. Something about the founder, the idea, the technology, something clicks as really being one, unique, and two, defensible. Like, is there some moat there? Now, for me specifically, which is maybe different from other VCs, is I'm only a co-investor, which means I don't set terms. That's right. I need another traditional, well-established VC to be the lead. So that to me also does a lot of my work for me. That's right. Because it helps me to validate if I know another, if Andreesson Horowitz or General Catalyst or, another great firm is already involved, that's already like doing a lot of my job for me. But beyond that, I need something to latch onto is that there is something unique and different about this particular founder.
Mm-hmm. It's also not too dissimilar to how we also work around venture debt and stuff like that as we come in alongside the institutional rounds. Exactly. Very similar to that. All right. How about just getting a meeting with you right now?
Yeah.
How does that work?
So a combination of different ways. Most founders I talk to, it's because something came through my network. If someone I know who I have some faith or trust with. It could be another VC. It could be an angel investor that I know. I work with a lot of angel investors. It could be other founders. Someone I know comes to me and say, hey, I've looked at this. I think it's interesting. You ought to take a look. I will. From a purely practical standpoint, as a co-investor, I sometimes say, let me know when you have a term sheet, because I just can't spend all day on calls. I need to be able to manage my schedule. I think
in that capacity, forgive me for interrupting,
Sure.
but in that capacity, do you move rather swiftly then?
Yes.
So
exactly.
okay, so in that capacity, like I'm a founder, I've already found my lead, right? I've talked to a number of founders in here today who have some leads ready to rock and roll.
Yeah.
And they're about to put together this thing. Once that happens, is it like hey Ron, we're raising this round, here's the situation, we already have these people going on, we have this much left to fill. Do you want to have a chat?
Yeah. So and then if I get a cold outreach, the highest likelihood I'll respond is if you tell me you already have a term sheet. Then I immediately want to know more.
And don't lie.
Yeah.
But
Yeah, and it can be
just
fine,
thinking
but,
about my next email term sheet.
Obviously I'll find out very quickly if you don't. But that can also be sometimes people raise on a safe and it's what's called a party round. I would still expect to see like an anchor investor, like some VC coming in for, even if it's $1 million and there's some VC who's going to do 100,000, that's enough to at least whet my appetite.
Oh, that's okay.
So
okay, I love that.
Okay too.
That's important to double click on real quick, okay? Because when you guys are raising your initial rounds, either friends and family, pre-seed, sometimes even seed, honestly, especially if you go through YC, and you're just doing it on a traditional like YC safe note, of which SVB actually wrote, we created seed debt to go along the safe note, by the way, with YC, which is pretty cool. But you often just stack checks. It's actually a really cool kind of a fluid vehicle for you to be able to do that. So just in case you don't understand that, you're just stacking checks. You don't necessarily need a lead. A lead is really kind of when you're getting a more mature round going together, you're doing a priced round, you're doing something else. So in that capacity, it's nice to know that you are still interested in if I'm stacking checks in a safe. But like, to use your example, if I'm raising a mill and I have someone who's committed, like visibly committed, then that's sometimes enough to come to you, even though they're not technically a.
Yeah, I'm still curious to learn. I understand
Yeah.
it's a practical matter. A lot of companies raise a first round, especially a pre-seed that way. And but let me throw in one other tip that surprises me that more founders don't think about when they approach VCs. So I'm the managing partner of the seed fund team, but I've got a whole team with me. I've got a principal out in the West Coast. I've got a senior associate in New York. I've got a senior associate in Boston. These are the folks whose job it is to source deals. Like, I can kind of sit on the ivory tower. I try not to, but essentially my role is to kind of approve, even though I do still source because I have a busy network and I like doing that. But for the junior members of the team, it's their job to source deals. If you approach the junior member of the team, you're actually going to increase your likelihood of getting a response and a reaction.
That's a good call. That's a great call out, because a lot of times people shoot for the top, and that's not incorrect in, depending on what the strategy is. But you bring out a good point. I mean, their role is to be out in market and have an ear and eye to the ground of what's happening, and then bring it up to you guys in your ivory tower.
And they often have more expertise than I do. And
I think they're dialed in. They're in the hacker houses, they're wherever they are, and how they're going to grow. What they're motivated by, of course, is bringing in the next cursor or something that's going to put them on a better pedestal within alumni. And so, cultivating that ground game with everyone, I think is critical, not just shooting for the top and being bummed out that you didn't get an email response right away, but really sort of strategically pulling those people together and making it happen. All right. So another thing that you do, which I find refreshing, but when I first checked it out, it was rather non-traditional, which was, okay, I've somehow gotten through to Ron's email. I've somehow gotten a meeting scheduled with Ron. Now I'm sitting in front of him at 30 minutes to kind of, do my thing, and then hope that there's a door open afterwards for me to continue, right? Traditionally, what happens is we roll in, we try to find some type of a center ground as a human. Humans still enjoy doing business with humans, right? You got to find that center ground. But then typically we go right into a pitch, right? Here's the pitch. Here's the thing. Here's the problem. Here's why nobody's handled it. Here's our team, and we're raising this much, right? And do you want to write a check or something? And they usually take up, and I'm hypothesizing, but I've also been in this seat. They take up the majority of the time going through a deck or going through whatever, and not necessarily connecting really deeply with this other individual, because ultimately you're hoping that you're going to enter into a 10+ year relationship, and you're going to be with that individual. Okay. So it's not just the check, Arthur Rock, if you guys know Arthur Rock, it's my favorite quote. He just said, it doesn't take a lot of ink to write a check, and it's about that additional value beyond it. But the approach is different. What Ron likes, and this is what I want you to kind of talk to us about a little bit more, is rather than the founder carrying on with that traditional approach, it's much more like, hi, how do you do? Spend 5 minutes connecting on the human element. That's the most important. Knowing me, I'd probably spend 28 minutes on it. But in general, then it's being like, okay, Ron, I'm going to tell you about the business in a second. But first, I'm going to tell you about the round, the terms, what we're looking for, and get all that out of the way. So that at this point, and now I'm just projecting, but now he's been able to dial in the aperture of the lens that he's going to now look at the business with. Do you get what I'm saying? Am I correct in that assumption?
Yeah, no.
Can you unpack that?
I mean, two points are making, agree with both of them. One, yes, the founders that can come in and build a relationship, the small talk is more than small. It's big talk. If someone can relate to me, oh, I see you've traveled to 140 countries. That's so interesting. What's your favorite? Or they can look and they've done enough homework to know what interests me. Like, most VCs have a pretty big digital footprint. It's not that hard to figure out if they're into golf or, traveling or have some hobbies or whatever. It's not that hard to figure out. If you can connect to someone on that level, you're already way ahead of 99%. And those end up being the best conversations. And that's immediately proving to me your EQ. So that's not going to sell me on investing. I can't get that, I like the guy, that therefore, or the gal, that therefore they're getting a check. But that certainly breaks the ice much faster than diving immediately into the pitch.
But at what point? No, actually, carry on. No, you carry on. I'll come back.
Yeah, I was going to sort of move, to the next point. I agree with you, also about the the round structure. I do like hearing that. I'm not too prescriptive about that if we don't get to the round dynamics till the end, but I do like to hear that early on because it sets my mind to know whether this is immediately actionable or if this is a conversation that lays the foundation for maybe something later on. It's just helpful to know, but it's not the be all end all of the conversations.
Interesting. I just honestly I like it. I'm gonna try it. Like on the next time, I'm gonna be like, just tell me about first before we go through
we
this.
Sometimes do that, and then sometimes the founder presents that, and then 5 minutes after that discussion, they kind of laugh like, by the way, I haven't even told you what the business is yet. And I'm like, that's okay, it's fine. Yeah.
So I mean, at Alumni, you started the seed fund. You also have a super angel fund.
So we have a super angel partner program that's sort of embedded. It's kind of like a scout program. We have a scout program too. There's like a nuanced difference between the two, but we work with active angel investors. It's a pretty neat program, actually. We sort of find some angels who have, good experience. They've been around either as operators or investors. They're clued into interesting, really early stage deals. They refer stuff to us. Sometimes it fits our model. When it does, we end up writing a check and we'll cut in some carry for them. So they benefit from the upside of having referred, and it's a win-win, right? They're able to help the company get another, VC on the cap table, it's helpful for them, it's helpful for the company, it's helpful for us. So that's part of what we do. It really supports the seed fund.
Yeah, and then that seed fund, the average check size is around what?
So there's a big range. It's a little complicated because of the way we're structured. So the seed fund itself will often write about a $50K check, but we sometimes write bigger checks because we also sometimes consolidate other pools of capital within Alumni Ventures. So we're not structured necessarily like a traditional VC firm. Organizationally, we're almost more like a small version of like a Fidelity Mutual or like a mutual fund company where there are many individual funds within one umbrella. So different funds might invest in the same company, but we're all one organization. We all sort of collaborate and, one team will lead a deal, but sometimes, will involve other funds and we have follow-on vehicles to write larger checks later. So our initial, even if it's $50K originally, that's not the end goal.
Yeah.
Eventually, we want to see that you're doing well. We want to show our value. And if there's mutual interest, we want to write a bigger check at later stages. So we write checks up to and even above 10 million. It just depends on the stage and the particular round dynamics.
Well, related to rounds, there's a ton of money floating around today, like more than there has been before. But it's obviously the deal count is at a pretty all-time low. I think you're probably keeping the deal count high relative to doing one a week. That's ridiculous. But it's getting sucked up, right? I mean, there's fewer deals, right? In Q2, one of my colleagues shared CB Insights data a little bit ago. It was like 200 million was invested, and I think 81% of that went to deals or something. So, what are you seeing right now in the market, and where's Alumni? Like, where do you see yourself having the most impact? And are you paying attention to these smaller raises and throwing in, capital there and supporting those founders? Or are you looking at these larger ones and, kind of participating? Where are you playing right now versus relative to where the market is today?
Yeah, you're right. I was just looking at some of the stats that it's a little bit counterintuitive that deal volume is actually a little bit down this year relative to last, which is kind of surprising because the market in some ways is actually doing better. It seems like valuations and it's a little bit of a discrepancy, but we are seeing some of these mega rounds. These mega rounds are the headline grabbers. There are a few of them, but typically what happens when there is that $100 or $300 million seed round, it's also at like some extraordinary valuation.
Right. And
it's typically based on a big idea with a really powerful team, but not necessarily much else. That's sometimes we as a firm will do them because we don't want to miss out if those have high potential. But the thing they lack is they don't necessarily have that same power law potential that I'm looking for. So, the power laws basically states, how venture returns work. So venture capital is a really strange asset class where you go in knowing that more than half of your investments are going to be a loser. And you'll have to forgive VCs for being skeptical, even if you're 100% convinced your idea will work, because we've seen enough to know that, the statistics tell me it won't, even though logically some of them will. So we go in, expecting that many of the deals will fail. We don't now any individual deal we don't think is necessarily going to be that one, or we're not going to do it. But that being said, we know that this happens. However, a certain number of them will do so phenomenally well that they can return in one deal, return an entire fund.
That's right.
That's like the 100 to 1,000 Xer, and those things do happen. And it's really exciting when it does. But when you go in at $100 million valuation entry point, you're reducing the likelihood of getting that kind of power law return. So I prefer to get in at a more reasonable valuation where I know if things go well, I can still get that big return. So the seed fund doesn't do a lot of those. We'll never say never, but we tend to do a lot more deals, in that pre-seed or seed, kind of the $5, $10, $20 million pre-money valuation on something that we think is a big opportunity. There's something that we're underwriting that we think can make this a really big company.
And, how are you evaluating these companies today and with the lens? Does Alumni have a thesis that you're going by, or is this Ron's thesis? Like, how are you executing these deals?
My biggest thesis is to keep an open mind, in all honesty. Yeah, we all have sort of individual areas of knowledge and things like, right now we might be going a little heavier in space tech and cyber and physical AI. These are kind of some of the hot areas, and of course we're paying close attention to the opportunities there. But we also try to keep an open mind to things we've never thought about, right? There's a lot of interesting markets that are maybe better understood by someone who's doing a postdoc at MIT and is really deep in something. And I'm not an expert. I haven't thought about that, but I don't want to rule it out just because I'm not an expert. So, in those situations, they might pitch me and, half of what they're saying is going over my head, but we can go back and try and validate some of that later through our expert network. Say, okay, yeah, this actually makes sense. And so, I don't know, one of the wildest ideas that we've invested in the last year was a company that's reinventing the moving walkway of all things. Like, why would you invest in that? Well, it's actually a really big market opportunity. It's a compelling, innovative technology that will make moving walkways safer, more reliable, faster, and everything else to disrupt an old market. And if it works, it's going to be in every airport in the world.
Yeah.
And the founders actually come from that industry and know what they're doing.
Step aside, Otis and Schindler.
Exactly.
We're coming after you.
No, exactly. Right. So why not keep an open mind? Obviously that's not something I ever would have thought of, but the founders had a really compelling story. So we did the deal. And
interesting.
Yeah, so anyway.
That's interesting. Okay. So, and that actually isn't even where I was going with this, but we are now in a very interesting and exciting time where there's just more opportunity than ever before to build companies. We've democratized access to technology for a non-technical founder like me. The vibe coding tools out there these days and everything else is it's like pixie dust. It's awesome. And, but I believe there to still be limitations, right? I think it's probably great you can get your MVP out there. You can even start getting revenue positive. You can build that feedback loop. You can do everything else. But at some point you might need to rebuild, create that actual IP mode or something to then continue to scale. Maybe not, right? But with that, this is kind of a multi-layered question. So the first question is, are you seeing more deals now than ever before because everybody with a laptop is able to spin up something over the weekend and say that they have a venture backable company and they come to you and they say they have a term sheet, even though they don't, but you know what I mean? Is that happening or no?
I would say the volume is, I don't know if it's the highest it's ever been. It's certainly pretty high. Solo founders can do more. And we hosted an event at our office recently that was really around a panel discussion for solo founders, because we believe it's part of the market now. And if you can do more faster, great. One of the questions on our scorecard is capital efficiency. So if you can build a lot fast, then that's great.
Just watch your token cost, right?
Yeah.
Et cetera. Go with the Chinese open source model. Well, okay, but within that, so everybody can build something over a weekend at this point. There's a lot going on. People are using very similar tools in a lot of capacities. Of course, now with Claude, and OpenClaw and all these other things, and now the open source models and everything else. And I am non-technical again, okay, but I'm doing good here, okay. But basically, is there a point though where we're at a time where I'd love to know how you view verticalization from some of these large companies, honestly, and then, basically leveraging people's data to train their own things and then spitting out their own proprietary stuff.
Sure.
We've seen that over history, over all the time,
Yeah.
but we're definitely now seeing it now. So I'd be interested in seeing how you view those kind of companies. Like, you're looking at a great company, they might be doing something awesome, but in the back of your mind, are you thinking verticalization from these big guys? Are you thinking that these guys have a 2-year shot to make it and sales cures all? And after that, that's all they got. Like, how are you trying to look beyond this pitch meeting and in the volatility of the market that we have right now and making these decisions?
Yeah. No, I mean, I think you're right when you talk about, like, is there like a data moat or something that makes, stand out? Like, what could one of the big guys, big LLMs, like, not replicate so easily? Because they have the money to do anything, but it's a matter of prioritization. And are there people that are such experts in a field that they can come up with something? So we invested in, several years ago, we invested alongside Excel in a company called Lincode, which does AI and quality inspection in heavy manufacturing, but they've built out their own proprietary database of visual images to capture defects that the human eye does not pick up. So it's like the next generation of AI